CTV's Adrian Gobriel checks out the comeback and whether Canadians will pitch their double-double to Dunkin' Donut. Okay, Adrian.
Sandy, let the donut wars begin. We all know that Tim Hortons is ingrained in Canadian coffee culture, though Dunkin' Donuts plans to make a return north of the border with a big splash, planning to open 50 stores per year across the country.
An iconic American brand has its sights set on taking a bite out of Canada's lucrative market for everything donuts and coffee.
Canada is about to get a huge coffee surprise with billions of dollars investment into the economy. Dunkin' is coming back in a big way, and people across the country may soon see new coffee and donut shops everywhere. This could bring more jobs, more choices, and fresh competition that may change how Canadians grab their morning coffee forever. In May 2026, Montreal-based restaurant operator Foodtastic announced it has signed a master franchising agreement with Inspire Brands, the owner of Dunkin', giving Foodtastic the exclusive right to develop and operate the American coffee and donut chain across Canada. Foodtastic plans to bring hundreds of Dunkin' shops to Canada as early as this year. The first location is expected to open in late 2026 or early 2027, with the initial focus on the Toronto and Montreal markets, before expanding to Quebec and Ontario broadly through the first 2 years, followed by the Maritimes and the West Coast. The announcement comes nearly 8 years after Dunkin' made its last exit from the Canadian market. Dunkin' departed in 2018 after Quebec franchisees successfully sued the company for not sufficiently promoting the brand. A $16.4 million civil court judgment was awarded to those franchisees, and the brand confirmed its total exit from Canada in September 2018. The legal defeat closed what had been a decades-long but ultimately unsuccessful attempt to establish Dunkin' as a viable competitor in a market where Tim Hortons built a cultural identity that went far beyond coffee and donuts. Foodtastic founder and chief executive officer Peter Mamas said in an interview, "It's a totally different company that's going to be coming this time around." His confidence rests on Foodtastic's track record as one of Canada's largest multi-brand restaurant operators. The company manages more than 1,200 locations across Canada, spanning 27 brands, including Second Cup, Milestones, Freshie, Pita Pit, Quesada, and Rotisseries Benny. Foodtastic used the same master franchising model with Inspire Brands to bring Jimmy John's to Canada in 2024, establishing a working relationship with the parent company that gave Mamas the pathway to pursue the larger Dunkin' opportunity. Mamas believes he can open 600 to 700 Dunkin' locations in Canada, including nearly 200 in Quebec. In my opinion, within 12 months, we'll be opening one Dunkin' per week, he said. The expansion sequence will begin with corporate-owned locations, what Mamas describes as working out the hiccups before expanding through franchisee deals. Under the master franchise agreement, Foodtastic has exclusive rights to the Dunkin' brand in Canada, managing market development, franchisee recruitment, and both corporate and franchise location operations. The menu Canadians will encounter is not a direct transplant of the American product. Foodtastic has 7 in-house chefs and 2 drink specialists who will adapt the menu to the Canadian market. Being Foodtastic, we're kind of privileged. We have over 7 chefs and 2 drink experts, so we're going to adapt what we need to the market, Mama said. The planned menu includes hot and iced coffees, espresso beverages, teas, donuts, breakfast sandwiches, and snacks. The cold drinks category is where Mama sees the most differentiated opportunity, a product line that appeals specifically to younger consumers who have demonstrated strong demand for iced coffee formats across the quick service segment. The competitor Dunkin' is returning to challenge is in a different position than it occupied when Dunkin' left. Tim Hortons now operates nearly 4,000 restaurants in Canada. It reported its 20th consecutive quarter of positive comparable sales in the week before the Dunkin' announcement, a streak that reflects sustained execution across its core coffee and food categories despite intense competitive pressure from McDonald's, Starbucks, and emerging European and Asian coffee brands entering the Canadian market. The chain has expanded its menu significantly, adding flatbread pizzas, carbonated fruit beverages, scrambled egg boxes, and a donut collaboration with Canadian actor Ryan Reynolds that generated significant social media attention. David Soberman, a professor of marketing at the University of Toronto, offered a measured assessment of what Dunkin's return means competitively. He said, when a big company enters a space already dominated by an established presence, it's often those with less market share that suffer the most. The two biggest players have the heft, if you will, to be able to compete with each other, he said. The implication is that Dunkin's return, if successful, would primarily squeeze mid-tier and independent operators, rather than materially damaging Tim Hortons' dominant position. David Pilara, a business consultant and marketing instructor at York University's Schulich School of Business, identified timing as a complicating factor. He noted the expansion is taking place in a muted consumer market for fast food companies, with McDonald's CEO Chris Kempczinski saying higher gas prices, spurred by the Iran war, disproportionately impact low-income consumers, who are pulling back on spending, putting pressure on quick service restaurants. Other major chains, including Shake Shack, Papa John's, and Domino's, have also cited the Iran war's economic effects as dampening consumer demand. Mama's acknowledged the current environment directly. Definitely, we're in a down period right now. The Buy Canadian sentiment that spread across the country following the 2025 tariff conflict adds a specific complication to Dunkin's positioning. Several Tim Hortons customers interviewed outside downtown Toronto locations on the day of the announcement said the American origin of the brand would factor into their choices. One customer said, "I think people are loyal to Tim Hortons and the Canadian brand." Another customer was more direct about the trade conflict context. "I don't like America at all. Trump is the biggest evil in the world." Mama's is aware of the Buy Canadian dynamic and has a prepared response. He said the Dunkin' shops will be run by Canadian franchisees. "It's definitely a very Canadian way of doing this," he said. He also points out that Tim Hortons itself is not purely domestic. Private equity firms based outside Canada hold significant shares in Tim Hortons' parent company Restaurant Brands International, even though the chain originated in Canada and RBI trades on the Toronto Stock Exchange. Mama's argues the Canadian franchisee model, combined with Foodtastic's Montreal base and Canadian operational infrastructure, positions Dunkin' differently from a straight American brand entry. Retail analyst Bruce Winder assessed the strategic approach as more disciplined than the previous attempt. "I think they're going to take it slow. I think they've done more research," he said, adding that the company will nurture the brand and find a unique flavor and menu for Canadians, instead of just bringing the same US product. The first location is expected in late 2026 or early 2027. After that, the target is one new location per week within 12 months, scaling toward 600 to 700 locations over several years. Whether Canadian coffee consumers navigating higher prices, a muted spending environment, strong Tim Hortons loyalty, and heightened Buy Canadian sentiment will run to Dunkin' in the numbers Mama's is projecting is the question the market will answer once those first locations open their doors.